Yes. Good afternoon. Today is February 17, 2026, but it may be a different day when you see us. It's good afternoon for us, but good morning, good evening to you whenever you're watching. My name is Valevska Watkins. I'm an attorney, a senior staff attorney for the Low Income Tax Clinic at Legal Services of Northern Virginia. This is tax credits, which is part of the Lunch and Learn series for this year 2026. I want to encourage everyone to learn as much as you can from the series, but really take advantage of the Volunteer Income Tax Assistance Centers, VITA centers, and the AARP Tax Aid centers around Northern Virginia and the nation. They are staffed by certified volunteers who can help you get the most out of your tax filing so you can take advantage of all of the credits we're going to discuss today. The agenda is here. We're going to first start discussing the difference between a credit and a deduction, which again may not be obvious to many people, but it has some real implications as we file. Then we're going to talk a little bit about non-refundable and refundable credits, delve into credits as such, family-based, the premium tax credit, which is for healthcare benefits, education credits, and then lastly, retirement saving and contribution credits. So to begin with, a credit is a tax benefit that directly reduces how much you have to pay. If you're told that a credit is of a certain amount, it's going to reduce your tax liability for that amount. Because tax credits, unlike deductions, are applied at the end of the process. There are two types of credits. One is refundable and one is non-refundable. What that means is that a refundable credit is an amount that you can take home, even if you don't owe anything, as a tax liability. A non-refundable credit can bring your liability down to zero, but then if there's any money left over from the credit, you don't get that as a refund. They're both good. Refundables are better, right? Because we end up with money in our pockets, but they're both great for diminishing, for bringing down what you may owe. The difference between a credit and a deduction, it may just be an intellectual difference, right? Because when you sit down with your accountant, with your VITA preparer, they will figure out which is which. But it's important to know a deduction is an amount that is subtracted from your income before we figure out the percent of money that you have to pay as a liability, right? Whereas the credit, you go through the process, we determine what of your income is taxable, what is not. We apply that percentage. And then if there's a liability at the end, we're going to subtract the credit. If it's refundable, it can take you to zero and then again, put some money in the bank. If it's non-refundable, at least you get to zero or simply lower how much you owe. Here's an example which I think is helpful. Let's imagine that you have taxable income of $35,000. On one side, we're going to see a chart on deduction and on another with credit. So we go to the second, well, really the third row, because the first row is title. We go to that second row and we look at deduction. If we're thinking about a deduction that is $5,000, that is going to bring down your taxable income to 30%. And let's imagine there's no deductions for this imaginary taxpayer on the right. That taxable income is going to be $35,000 instead of 30. As you see, when we do the magic of applying the tax rate, the percent, we're going to have different results. So for the taxpayer that is receiving a deduction of $5,000, that 20% of 30 is 6. For the other, obviously, it's a higher amount. So the tax, the 20% is going to be 7,000. When we apply a credit, right, to that taxpayer on the right of $5,000, that person ends up in a better position because all they have to pay is $2,000. Whereas on the deduction side, it's $6,000. This is just an example. Math is hard. I understand that, but it's just to give you a visual of when a deduction is applied as opposed to a credit, and how credits can sometimes be more advantageous than deductions. We don't get to decide, right? Congress decides how we're going to treat this benefit, and we just have to apply it. Now, I told you there's two different types of credits in terms of what they can do for your pocket: refundable credits and non-refundable. So let's assume same taxpayer ends up owing, in this example, $1,500. And we have a credit amount that's the same amount, $2,000. Now, if we have a refundable credit, that $2,000 of the credit is more than the liability, right? So that $500 extra you can put in your pocket because it is refundable. Where it's non-refundable, then it simply takes you to zero. You can be happy that you don't owe anything, but it's not going to increase the balance in your bank account. Some of the other concepts that we should understand well as we go through the credit presentation is dependence. Not all, but some credits are going to be increased if you have dependents. Some credits you will only receive if you have dependents. So when we think about dependents, it has to be a qualifying child or a qualifying relative. When we're thinking about children, it has to be a child that lives with the taxpayer for more than half of the year. So it's going to be half plus a day. This can be important when we have families that are multi-households, so the family is separated or divorced. It's important that the person that will be able to claim the dependent for tax purposes is going to be that lives with the child for more than half of the year. The child themselves cannot pay for more than 50% of their own support. That's important. Sometimes, teenagers work, students are in college or technical school and they're working, but it's important that even though they work, they cannot support themselves, right? Whatever they earn is not more than 50% of their support. In terms of age, it's going to be different for each of the credits. But here, the example would be for the earned income tax credit. The dependent, the existence, right, of a qualifying child might increase how much you get if that child is under the age of 19, regardless of anything else. Now, if the child is, let's say, under 24, so 23 or less, and a full-time student, then you can claim that person as a dependent for the earned income tax credit purposes. Now, if the child is permanently and totally disabled, it's a person that can really not engage in substantive work to support themselves, then it doesn't matter what the age is. It is really important that it used to be different in the past, especially during the pandemic. There were many different limitations or abilities to get credits, but right now, only individuals that have Social Security numbers and whose dependents have Social Security numbers can claim most tax credits. For relatives, it's different. I should have included this exception. So for a relative, let's say a sibling, your uncle, a cousin, they live with you all of the year. This has an exception, which is for parents, because sometimes parents are our dependents, especially in their golden years. They might live on their own. They might live in an assisted living facility, but you are still providing more than 50% of their support. Then you can claim them as a dependent for tax purposes. It's also important that this relative must have gross income less than $4,700. It's a number that Congress has chosen. It is what it is. It may change in some years, but for this year, that's the magical number we need to look at. Remember that when we talk about this, we're really thinking about taxable income. You should consult with your tax preparer, but generally, if your parent, for example, receives more than that, but it's Social Security, it's not taxable income, we're not even going to be concerned with that. But again, consult with whoever is helping you prepare the return. Now, these are the major tax credits that we're going to be talking about. There are more, but for purposes of LS&B and our low-income tax clinic, these are the ones that we see the most. So let's start with the earned income tax credit, which I already mentioned. As I said before, having a qualifying child, a qualifying dependent, is going to increase how much you can receive if you qualify, but you don't have to have a dependent. If you don't, you may still receive some, but it's important that we understand the earned income tax credit is intended for workers, for individuals engaged in the labor force that earn up to a certain amount. And that's what this chart is telling us. So let's think about what is the filing status of the taxpayer. Are you single? Are you married? Are you widowed? Are you married but filing jointly? Do you have any dependents? All of those factors are going to influence the top income that you can earn to receive any amount. And let's consider that this is a very simple table. The IRS has prepared tables, and the software recognizes that the more you earn, automatically, the less you're going to qualify for in terms of the earned income tax credit. The more dependents you have, the more that you're going to probably qualify for within the income ranges. But as the dependents get older, the credit also gets smaller, or at least the credit addition from having a qualifying dependent. As I had discussed before, there are certain limitations or requirements to qualify for this. It's really important, and I'm going to begin with, that the IRS does not recognize dual custodial parents. So if you're divorced, if you were never married, but you share custody or share children with another person, only one parent can claim. Generally, it's going to be the parent that can meet all of the requirements. Parents, however, can agree to do something different. There are forms that you can fill out to let the IRS know that the two of you have agreed that one parent or another will claim the child regardless of where the child lives, for example, or who actually supports the child. You can decide that, but only one parent can claim the child. It's important, as I said, that both the taxpayer that claims the dependent and the child have to have Social Security number. This is incredibly important. I've had some cases that Social Security number must have been assigned as of the filing deadline. And by that, we mean April 15th of the year when you're filing. So April 15, 2026 is when we have the deadline for filing last year's taxes. If your child has not been assigned a Social Security number as of that date, so that you can include it in the filing, you cannot claim this person. You cannot go back later and amend the tax return. It's not retroactive. This is just the way it is. Seems unfair, maybe, but we have to have some limitations, right, into the entry to the program. The second set of requirements, as I had discussed, have to do with age. The third has to do with the relationship. It has to be your biological child, an adopted child, a foster child. It has to be someone that has an established legal connection to you. It cannot be that you are informally fostering someone, but there's no documents from a court, from a social services organization granting you the ability to foster this child. You must be able to prove that. And again, we had already talked about, unless there's an agreement between parents, it has to be that the taxpayer has lived with the child has lived with the taxpayer for at least half of the taxable year, and that living together has to happen here in the United States. In other presentations, I have talked about how the married filing separately status is really disfavored by the IRS. It is what it is. We just have to accept it for purposes of this representation. And so there's going to be some additional requirements. You would have to show, in order to claim a qualifying dependent, that you have lived apart from your spouse for the last 6 months out of the taxable year in order for you to file as married, filing separately, and claim a qualifying child. Otherwise, because there are situations where spouses don't have the immediate resources to separate the household, if that's the case, then you need a written separation agreement. It's an order of the court that you will be deemed legally separated, even if you're living together. Very well. The maximum amount that you can receive for the earned income tax is going to depend, as I said, on your filing status and the amount of children. So when you look at the numbers here, no qualifying children, up to 649, again, remember, it may be that because you're such a high earner within that range, you end up receiving a lot less. Maybe you only qualify for $49. But still, it's an amount of money that you otherwise wouldn't have. So kudos. And again, it can go up to $8,046, but that would mean that you have 3 or more qualifying children. Generally, they would be younger children, and that your income would be in the lower ranges on the tables. So don't be surprised, like, oh, I have 3 kids. Why am I not receiving $8,000? Because there's many factors. How many qualifying children you have is just one. EITC, so the Earned Income Tax Credit, is one of the programs that gets audited the most, not just amongst our clients, but generally. There are reports, there have been investigations. It's just what it is. This happens quite a bit when there are multiple claims for the same child. So when there's parents who are separated or were never together, and they both claim the child as a dependent. When that happens, then both parents are going to be audited. They're going to have to establish their relationship. And this is where things get thorny. You have to establish that the child, again, lived with you more than half the year. The third factor, you are going to have to show that as a taxpayer entitled to claim the child, you have been paying more than 50% of the household expenses. Oftentimes, when there are close enough situations, the IRS tends to favor the parent that earns the most. And when would that be? Well, perhaps both parents have included the children in the leases, because you really have to include individuals who are going to regularly stay with you, whether it's most of the time or just in the weekends. So that wouldn't really tell the IRS how to decide. Perhaps both addresses are part of the school records. Both addresses are part of the medical records. If the IRS can't figure it out, it's probably going to decide on the basis of who has the higher income, assuming that whoever has the higher income is going to incur more expenses. That's not always true, but you can show that through the audit process. One of the things in doing this that can be problematic is when the parent has cash income. Perhaps you have the higher income, but if it's all on cash and it's through a cash app, then it's going to be hard for you to demonstrate it. Another tax credit that we need to talk about, it's the child tax credit. This one you only receive if you have qualifying children. If you don't have any children, you're not eligible. This has a refundable and a non-refundable portion. Remember, non-refundable means that it can take you to zero, but then you cannot take any of the remaining amount home. You can receive up to $2,200 per qualifying child. In this case, the age is different. The child has to be 16 and under on the last day of the taxable year. Out of these $2,200, $1,700 are refundable. So even if you owe nothing, you're going to end up taking home $1,700 per child. But it's important that for you to be eligible for that refundable portion, you must have had some income. Specifically for this year, you must have had $2,500 of income at the very least. Sometimes we've had individuals who have had less than that or less than the annual required amount. They come to us, and unfortunately, that is just an arbitrary number that Congress has imposed and that we have to follow. And again, I got to remind everybody that all dependents that qualify for this and taxpayers must have a Social Security number. I also want to remind you that as we agreed or talked about, could be agreed for the earned income tax credit, you can also enter into an agreement with a non-custodial parent so that they can claim the child, but it has to be through a formal document, a form that the IRS provides. Okay, this is also something that you can only receive if you have a child or dependent. It's the Child and Dependent Care Credit. This is non-refundable and it's only accessible to individuals who work or are looking for work. The age of the dependent is going to also vary. If we're talking about minors who are your dependents, right? They could be your tax dependents. But to qualify as dependents for this credit, they have to be younger than 13, so 12 or younger. They must be receiving some sort of daycare services from a third party. Or it could be for an adult, right? An adult that is physically or mentally incapable of taking care of themselves. It has to be an individual that lives more than half of the year with you. And that's important because what this is intended to do is to ease the burden of whatever you're spending on the care for this individual so that you can work. This is not a dollar for dollar credit. You can only receive a portion of it. And the way it works is that the maximum you can receive for one qualifying person is $3,000. For two or more is $6,000. But you can only receive up to 50% of the eligible costs, and that 50% or a smaller percent cannot be more than this $3,000 or $6,000. Here's a table that helps think about it a little better. If you are on the lower range for the adjusted gross income, let's say you earn $50,000 a year, then there's a new rate that applies and you can receive up to 50% of what you spend on this daycare expenses. As you can see, there are ranges of income. Individuals who earn $206,000 or more per year, they can only receive up to 20% of their expenses reimbursed. It is important, as I said 2 slides ago, that this is generally intended for a third party to take care of the child. It's not something that you can simply get reimbursed if one of your older children is taking care of the younger children. That's sort of a duty of family to take care of one another. In general, when you go to your tax preparer, you want to bring a letter and you want to keep it for your records from this third party. It should include their employment identification number. It may be that it's a nanny, it's a babysitter, so it would need to have their social security number. And it should state how much you have spent and give some details as to who is a household member receiving care, how many hours, just some detail as to how the monies were spent and who received them. Okay, here. The premium tax credit is generally what people call the tax credit received by those who purchase their health plans through the Affordable Care Act marketplace, the Obamacare marketplace. This is a form of assistance that calculates how much you can afford and how much you should receive in subsidies so that you can buy coverage for a qualified health plan. And you would know it's a qualified health plan because you're going to be on the website and they're going to give you specific choices. The advance payment tax credit, the premium tax credit, it's going to be made throughout the year. It's going to be really important that if your income changes throughout the year because you get a better job, because you get a raise, you have to immediately inform the marketplace. There are ways that you can log on and change your profile and change that so that the subsidy you receive can be adjusted. If it's not adjusted, unfortunately, when you file, you are going to have to reimburse the government for any excess amounts that you receive and shouldn't have. You will know, if you're doubtful, you will know that you are the kind of customer that has bought through the marketplace. It's surprising, but I've had clients that don't know. Or don't quite understand that this is what we're talking about. But if you receive a Form 1095-A, it's going to look pretty much all the ones that I've seen, they're going to look like this one here on screen. It's going to show the subsidies that you receive throughout the year. And this is going to be important because as a tax preparer, I do this with some frequency. We have to input each and every one of those amounts. It's easy when it's the same amounts as with this form, but sometimes it changes because, again, your income changes and you report it. And it's important. If you don't submit the information on this form, simply the software is going to reject your filing. You're going to have to redo it because they do need you to reconcile the expenditures. This is joyful. Credits, tax credits for learning. This can be extremely helpful both to parents who have students in technical schools or colleges, but also to professionals that are seeking to improve their skills and have continued learning expenses. So again, the student could be the taxpayer, it could be the spouse, or again, a dependent. It depends on each credit, how much you can get back, but you always have to have qualified expenses. So each one might define it differently, but we're thinking about tuition, about fees that are necessary to enroll in the program, and course materials. It is also incredibly important that where you're taking these classes, these courses, and the institution that is receiving your payment has to be an eligible educational institution. And the way to figure that out beforehand is to go do a search. There is a database where you can compare the name of the institution, the address. It gives you all the information so that you know whether or not you'll be able to receive a tax credit. It is also incredibly important that the person who claims the student as a dependent is the person who can claim the credit. If you have a student that you're claiming as your dependent, but it turns out that your rich uncle is paying for the school, for the college expenses, for the trade school expenses, only you can claim this credit. Maybe you can give that credit back to your rich uncle, but he cannot go ahead and claim your child as a dependent for this unless the child is his dependent for other purposes as well. And again, like everything else, there is a charge for it. How much you can earn and how much you can receive in this tax credit is going to depend on your filing status and on your income. So as you can see, if you're married filing separately, you simply cannot claim this credit at all. As I told you, it's a very disfavored filing status. But if you're filing jointly as a married couple, or if you're a household, if you're single, you are going to be able to take at least partial credit so long as you are not earning 90,000 or more for single head of household and qualified surviving spouse, or 180,000 if you're married filing jointly. There's a spectrum, right? You can get partial credit depending upon how much you earn if you earn less than that. This is important. Non-resident aliens who may want to claim this credit can choose to be treated as resident aliens for tax purposes. That is a process that can happen as you are filing your tax return, but you're going to have to really go to an expert for this. You have to, again, fill out some forms, create some affidavits, provide some evidence. So that's the kind of information we could provide you as attorneys, tax attorneys. An accountant can provide you this. Perhaps also some of the tax preparers at VITA and ARP centers can help you with that. Very well. So focusing on the American Opportunity Tax Credit, it's going to be up to $2,500. Out of this, 40% is refundable. Let's remember, that means that if you qualify for the full $2,500, but you don't really have a tax liability or you have a small tax liability, 1,000 of those are going to be refundable. You can take those home. This is a credit that is intended really for just a 4-year degree, up to, right? A 4-year degree. You must be enrolled at least half time. We usually say full time, but the form says, is the student enrolled at least half time? Yes. It's important. No felony drug convictions can be on the record of the person enrolled at the institution. And this is going to be for specific like tuition, fees, and course materials. What wouldn't be a qualified expense? I would say if you have to pay parking because you're a commuter, parking, that's not an expense that you can report for purposes of this credit. Then there is the lifetime learning credit. You don't have to be enrolled in a 4-year degree. Indeed, you don't have to be pursuing a degree at all. As I mentioned before, it could be continuing education so long as it is at one of the institutions that are qualified as legitimate, as recognized by the government. This is a little less. It's up to $2,000 per return, but it's non-refundable. The other one we said $2,500, $1,000 refundable. This one is $2,000 not refundable. Let's see. Tuition, fees, and materials required by and purchased for the school. Again, there's going to be limitations. Some are going to be different, but I don't believe that under either credit you can deduct or calculate parking fees for receipt of this credit. If you qualify for either of these, you should know that because you did your research before. You looked at the institution's accreditation, but you will also know it because when you access your profile or when the student accesses the profile, they're going to see under tax forms a 1098T. It is incredibly important that the 98T is going to include both tuition on box number 1, how much was spent on tuition, but it's also going to include scholarships and grants. So let's use round numbers. Let's say that tuition was $10,000, but box 5 says that $5,000 were granted as a scholarship or grant. Then that means that only $5,000 could be used to claim one of these. Remember, you can claim up to $2,500 for the American Opportunity Tax Credit and $2,000 for the Lifetime Learning Credit. So you could split that so that you can get the most benefit. It is important that when you have scholarships, there are restricted and unrestricted, right? So that's why it says here that unrestricted scholarships and grants can be applied first to non-qualified expenses. And that's where parking is. If you receive an unrestricted scholarship, apply that to parking because that's an expense. It's legitimate. And then for the restricted scholarships, then we can work that in so that you can receive the most benefit out of everything, right? You're not going to be able to claim parking expenses otherwise through the 1098. So use those unrestricted scholarships for that. This is not in red, but this is generally what the 1098T would look like. This says 2020. Yours should say 2025, as that's what we're filing this year. And as you can see, box number 1 says payments received for qualified tuition and related expenses. And if you keep going down, 5 says scholarships and grants. Okay, this is the last credit we're going to discuss today is the retirement savings contribution credits, generally known as the Savers Credits. What it does is that it encourages workers to save more than the minimum. So let's imagine that you're part of an individual retirement account, right? You have an IRA, a 401k, a 403b, etc. And there are matching funds from your employer. So you contribute whatever is the maximum or whatever is affordable to you and then have your employer match it. Well, if you decide that you want to contribute a little bit more because you truly want to ensure that your retirement is more comfortable, this allows you to get a credit for that. Again, as you can see from the chart here, it's really going to depend on your filing status and your income. So depending upon how much you earn is the percent, the credit rate that you're going to receive for your additional contributions to your retirement programs. I want to remind everybody that the filing deadline for the federal tax return is April 15th. If you absolutely have to request an extension deadline, please understand that you have until October 15th. What that is going to mean is that if you request that extension, you will not be penalized. You will not be assessed a penalty for late filing, but you're still going to be assessed late fees if you owe any monies. For Virginia, our state tax return is due May 1st, 2026. This is our contact information. If you need services for a legal controversy with the IRS or a related controversy with Virginia taxation, you can call us at 703 778 6800. We are not tax preparers. We're not accountants that can help you with your tax return. Please go to VITA or the AARP tax aid centers for that. What we do is we help you once you're being audited, whether it's EITC or some other reason. We could also help if you're having problems making payments and need an offering compromise. I'm going to stop the recording now. And before I do that, I'm going to wish you a great rest of your day. Thank you.